Thank you all for coming. My name is Paul Ellis. On behalf of the New York Technology Council, we're pleased to have you all for this event, Long-Range Planning for the Successful Sale of a Company. Before we jump into substance, I'm going to go through a little bit of introductory formalities. This is the New York Technology Council. It's an organization dedicated to the support and promotion of the technology community in New York City through a combination of educational events, resources for our members, advocacy, both here locally and in Washington. We'll start by just calling out quickly our sponsors. We have a large number and a growing number of very supportive sponsors, that many of whom have been with us from the very beginning of the organization. We thank them for their support, and they're certainly a big part of helping us put on events like this. In particular, our featured sponsor this evening is the accounting firm of Eisner-Amper. We also have Mike Lopez here, who is our board member from Eisner-Amper. Eisner-Amper has been with us from the very beginning. Mike is a founding board member of the organization. They've been very supportive. They have a deep expertise in the community, so we're really very pleased to have them as a very supportive sponsor of the organization. Also, we have our partner organizations listed here on this slide that we work with in terms of all of our events and activities, so we're very pleased to have their participation as well. Finally, our media partners, VentureBeat, New York Convergence, and the New York Enterprise Report. And of course, special thanks to our host this evening, the New York Institute of Technology. They've been very supportive with this great space that we're using tonight and have used many times, so we thank them for their support. This evening, this topic is one that we last did in 2010, long-range planning for the successful sale of a company. It really came out of experiences that I had with my clients. I've often had clients that I represented from formation through financing and then an exit, and I saw that there were a number of issues that came up for them, and it was important to have a way to give them some sort of a cohesive presentation to help them with the issues they needed to know along the way, so that by the time they got to an exit, they had tied everything down. Their corporate housekeeping was in shape, their finances were in shape, they thought about who their buyers were, and they were ready to go. And this was a presentation that I originally conceived largely to help out my clients, and I'm pleased to see a number of them here in the audience, so I hope that proves out the thesis. I'm going to just say a couple words about myself, and then I'll leave the rest of the panel. Each can introduce themselves and say a little bit about their organizations. Again, my name is Paul Ellis. I'm the principal of a sixth lawyer firm, Paul Ellis Law Group. We do a lot of work with small to mid-sized technology companies. In addition, we represent individual and institutional investors, high net worth individuals, and venture capital funds as well. We all come out of large firms, but we're now practicing in a small firm, giving us the ability to represent these companies with sophisticated big firm expertise, but with personal attention in a cost-effective way. We also, due to the amount of work we do in the technology community, we have a lot of connections to service providers that work in this community, accountants, bankers, consultants, as well as investors. So we're often able to make referrals and introductions. In terms of the type of work we do a lot of formations, financings, angel, seed, and venture capital. We do equity plans. We do employment agreements. We do intellectual property protection, patent applications. And last but not least, we do a lot of mergers and acquisitions, buying and selling companies, which is sort of bringing us to the topic of this evening. As I said, we've often taken companies from formation to exit, and so we have seen these sorts of issues come up from time to time, and so this is a topic that we have a lot of experience in, and we're really pleased to be able to be a part of it. So I'm going to introduce the rest of the panel. To my immediate left, I have Don Moore, the Managing Director of Signal Hill, an investment banking firm. To his left, Corey Massella, a partner with Citrin Cooperman. And then finally, Jack Early, a serial entrepreneur and angel investor with Cherrystone Angels. I'm really pleased that we have such a great panel this evening and real experts in this area. I'm going to leave it to them to say a little bit about themselves and their organizations, and then we'll jump into the substance. Don?
Sure. Thanks, Paul. Signal Hill is a 60-banker investment bank. We focus purely on serving technology companies, sell side, buy side, and private placement. We're lower to middle market focused, so our deals average anywhere 50 million on up. And we have an office downtown Manhattan, as well as offices in Boston, DC, Baltimore, and Nashville. And the team started when, after Alex Brown, which is an old investment bank, was acquired, a bunch of partners spun out and started the firm. And I came out of another firm that merged called UpData, which has been a tech-focused investment bank, and also a fund that spun out for about 25 years. And I joined UpData about 15 years ago. And I focus primarily on internet and security companies.
You want to pass me that?
Oh, sorry. Sure.
There you go. Hi, Corey Massella from Citrin Cooperman. Just to speak about Citrin. Switch it up. Just to speak about Citrin Cooperman. It's a firm that's been around for 30 years. We have 350 professionals. It evolved where we basically had 30 plus mergers along the way. So it's a group of entrepreneurs that really came together. Now what that brings is a lot of people in this sector are entrepreneurs looking for accountants that are different, that have been through it and can advise you in that sector. And that's sort of what we bring. Our offices range from Connecticut down to Philadelphia. We have 5 offices. We provide services internationally, domestic, and we also address many issues that are very specific to tech companies, which would revolve around state and local tax issues, doing business over the internet, and that's a very hot area right now. We have a whole group that just focuses on those areas. My background is I'm originally at a big, similar to other people here, developed my own firm, but my sectors are, I've dealt a lot in funding, mergers and acquisition, companies that have gone public, some that aren't public, and the big focus is in tech and financial services and multiple other areas too. I'm also on the board of 3 different angel investing groups, so I see companies looking to raise capital. I can't even give you the litany of numbers I see per month, but it gives me a good flavor for what's going on in the sector and where investors are investing.
Thank you, Corey. My name is Jack Early. I'm really happy to be here because I love coming down to New York. And my background is in the operations side. I've built a couple of software companies and I've sold them. And in the last, say, 12 or 13 years, I've been on the angel side. So I usually am in the first one in and engage at that level. And I'm happy to share some of those thoughts with you today.
All right. Thank you all. And I should say, part of the reason we put this panel together as we have, we are especially pleased to have Jack involved because he, in a sense, sits a little bit more where many of you sit. As he has walked the walk, he is, well, several of us here have had experience with on the company side, but Jack is a serial entrepreneur. He's an angel investor, so we hope for him to bring a little bit of the counterbalance to the service providers and the professionals. Some of the color, yeah. Well, we had a call the other day, and before the call was out, we were already having differing viewpoints on various topics. So I'm sure hopefully we'll have an open and frank exchange of views, as they say in the State Department. All right, so now we're technically, I hope this is going to go smoothly. I was hoping to have the keyboard down here, it hasn't really worked out that way. So I'm going to have this here, but if I get out of sync with the slide, you can throw a shoe at me or something, and we'll advance the slides here. So let's talk quickly about what we're trying to do today. The focus of this session is really long-range planning. We're not focused on a specific event. We're not talking about what happens when you have a particular buyer who is talking to you about wanting to buy your company. We're talking about the things that you need to think about much in advance along the way, okay? We're talking about the issues that are going to build value, make the company attractive, and make the process as smooth as possible. We're talking mostly to early stage, but also to more established companies that are contemplating an exit within the next few years. And I guess I would say that we can't really give you all the answers. The idea here is really issue spotting. As I said, this is sort of comes out of my experience with my clients, knowing what are the issues that they need to think about early in the life of their company that will help them so when they come time to an exit, they're ready to go. Okay? The way we're going to go through these slides, many of them I will take the first pass at, and then the others on the panel will give their thoughts, but everyone's going to be leading us through a few of the slides. We'd like to do some Q&A as we go, so if there are issues that come up along the way, feel free to jump in with a question. We do have a lot of material, though, so at certain points I may just have to push things forward. We'll try to leave some time for Q&A at the end as well. Okay? With respect to specific topics to be covered today, entity and jurisdiction, what type of company you form and where should it be formed, founder relations, important topics to be addressed at the very early stage in terms of equity share and relationships among the founders, industry intelligence, keeping apprised of what's happening in your industry so you're ready and you have the information you need to know when the time is right for a sale, building value in the enterprise, what are the things identifying the things that are going to be important when it comes time for an exit, outside advisors, what type of advisors, when do you need them, who should they be, attention to accounting and tax matters, to have all of the financial matters and tax matters in shape when it comes time for an exit, corporate housekeeping, resolution, annual meetings, and the like. Shareholders and their rights. What are the things that you need to have in a shareholders agreement to make sure that you're ready for an exit? Contracts and particular provisions. What are the provisions that you need to make sure either do get into the contracts or do not get into your contracts with your vendors, customers, suppliers along the way so you'll have a smooth exit. Personnel issues, very important topic. How to make sure you're ready with respect to your employees and consultants. Protecting intellectual property so your IP is in shape and doesn't create problems with a potential buyer. And the ever popular compliance with securities laws, lawyers' favorite topic. Okay, so let's talk about the end game, where we're going, and why the content here is important. At the end, when you are in play, what are the things that happen? There's the identifying or choosing of a potential purchaser, negotiating of a term sheet, price, escrow, reps and warranties, and the like. Due diligence. Diligence, for those who are not familiar with it, is something we'll be referring to many times throughout the evening, so I'll pause on it briefly. When your company is in play, once the deal has been negotiated, or at least when a term sheet has been signed, we go through a process of due diligence, which is when the buyer wants to know everything about the company. They'll ask for your contracts, they'll ask for your corporate records, they'll ask for your finances, they'll want to talk to your customers, to your suppliers. They will want to really take a deep dive, everything about the company, to assure themselves that everything is as you're telling them that it is, everything is in order, and to really verify the value of what they're getting. A lot of what we're talking about this evening is being ready for diligence, so that when they take that deep dive, there are no surprises and they like what they see. And then finally, documenting and closing the transaction. Okay? factors that are going to influence the outcome of this end game. Knowing when the time is right, knowing when it is the right time to actually be selling your company, knowing who your potential buyers are, knowing what it is that's going to be important to them in terms of valuing the company, and a smooth process. Everybody hates surprises. Again, this comes back to diligence. You don't want them to be surprised. You want, when they look at the company, for them to go, okay, that's right, that's right, that's right, everything looks good, let's go ahead to closing. The content this evening is to help you get there. Bottom line, you need to focus on these factors long before you're actually talking to a potential buyer, okay?
Well, if I can make a comment on that issue of the diligence. For the acquiring company, this is often a tool that they use to burn a lot of hours, and particularly in smaller companies, they can absolutely suck every ounce of energy out of you while they're going through this process, and to the point where you're forgetting about your customers and your customer support issues and so on. And also the other piece that's not on here that we really need to talk about, or they will certainly be aware of, is cash availability. So if you're a company that's kind of like on the borderline, or you're running at a loss, and the acquiring company comes in and says, well, we're just going to do this for 7 months. Well, you have to finance that 7 months typically, and in addition to burning all the labor that's going to be involved with it. So those are really key considerations going through the process.
Yeah, I'd say it's very important. I mean, you don't want to start missing your numbers as you're coming up on an exit, and it can happen because, especially if you haven't been through the process before, you will see that it just drags so much of your time and attention going through the process. So you want to make sure that you have certain people that are working on the deal, but certain people that are keeping the company going along the way. So.
Just a comment with some of my experience. You also, if you're the seller, you want to make sure that even if the buyer appears to be serious, once you start giving him or her lots of information and it's in line, they may choose to walk away, and you need to be rewarded from that. I had a client who was made an offer, and a day later it was rescinded, and the seller got lots of market intelligence, and the client went ballistic, but she didn't listen to me and give a walk-away clause. So, I mean, if somebody's serious, and it's a substantial business and not just a dream, somebody can get a
You've got to have real leverage to ask for that clause. And, it's very rare. Maybe you'll get it, but, a big company's not going to typically look at a little or a smaller company and say, sure, we'll give you a walk away.
Well, this was a $10 million company.
That's a nothing company to most of these guys.
Got it from somebody else.
Yeah.
I think the strongest leverage you have really is making the process competitive. So qualifying the buyer, and the buyer having a limited period of exclusivity, and having them be aware that there are others kind of waiting around the hoop. So that's probably the strongest sort of defense that you have. And I agree with Jack. It's very hard to get a breakup fee unless you're really big. So.
This is going to lead up to. I just heard this morning. I was listening to Heidi from Linkshare, and she's pretty famous for what she sold out at. But she was describing the circumstances when she went through the process of selling the company. And one of the issues that came to light when she was doing it, the process takes a long enough time, but her job was to keep vision and stay on top of things and stay ahead of the curve. And they lost it during the 3 to 4 months of the process of selling the company. And had she not sold, she would have been behind in her business. So it leads to where we're going to probably be going here with the panel. If you have your ducks in a row and you're ready to sell and you've got a good format, which we'll be describing, you can limit and get to the process and get to the conclusion quicker and limit the damage of the distraction of putting yourself up and going through this.
Yep, absolutely right. And we could spend all evening talking about diligence and this piece of the process, but let's move on. Entity and jurisdiction, first topic. We're not going to spend a lot of time on this, but there are a choice of structures that may make sense for your company. It may be a C Corp, it may be an S Corp, it may be an LLC. This is a topic you're probably going to want to discuss with your accountant or your lawyer. The LLC is obviously very popular right now. I'm probably forming more LLCs and corporations these days. They certainly do have significant tax benefits, flow through taxation, elimination of double taxation and asset sale, enhanced ability to deduct losses. Corey could tell you a lot more about these issues. Obviously, there are problems with the LLC form as well. Probably the most important one is that if you're going to be seeking investment along the way, VC investment, an LLC will not be a satisfactory vehicle, and you'll end up converting. Or if you're looking for foreign investors, I have a client that is getting angel investment, but because he's taking foreign money, they don't want to be investing into an LLC, so he's still having to convert to a corporation. There are also problems with employee equity plans, other issues as well. So these are issues that come up with an LLC. The jurisdiction of your company should generally be Delaware. Certainly if you're going to be seeking investment, Delaware is very much preferred. There are companies for which a New York entity is fine, but for the types of companies that we're talking about today, probably you're going to want to be Delaware. Consider early on whether you should be segregating the different lines of business. Don't knock yourself out over that, only if it makes sense. But there are situations where you may end up wanting to spin off a certain line of business. If you've segregated that into a separate entity, that makes it easier. Ultimately, these are all issues that you will probably want to consult with accountants and lawyers along the way to the extent it's appropriate. Yeah, please.
The only quick advice I would say is just to be aware that if you start with an LLC, you can always convert over to a C Corp and make that change, but you can't go from a C Corp back down to an LLC. There are tax consequences that are involved there. So a lot of companies, sometimes if you're not sure where you're going to go, it's not terrible to start out as an LLC. And as you diversify, there's a little bit more flexibility. So just trying to keep this simple. So.
Yes. Jack, do you want to take the next slide?
Founder relations, I think, is essential as a main topic, and you need to have a lot of discussion about this when you're starting a company. The thing that I always fear is when I sit down for the first time with the entrepreneurs and they said, we built the whole company idea in the pub and we split the whole technology up on the back of the napkin and then we did the split on the company's equity. Well, that's probably not the best way to start off, because at some point there's really not three people who are really completely equal in the equation. So part of what you really have to do is put some focus on this and maybe step away from the bar when you're ready to do the equity split, because that's really not going to be the best way to do it, and it is going to be an issue downstream. When I talk about equity percentages, not only on the founding team, but also on when you're recruiting executives. I had an instance recently where a young woman had started a company, and she was desperate because she felt so alone. So she went out and got a chief operating officer who was a year younger than she was, and she had just graduated from Brown, and she gave the woman 20% of the equity. And this is for somebody who has never, ever had a job before. So once again, as outside angel investors looking at this company, we got problem number 2, because that's disproportionate to what she should have been getting at that level. What's fair, what's defensible when you're approaching outside investors? These things have become important. I put down reverse vesting. This is a critical issue to new investors, because when you sit around the napkin and everybody decides to do it, and 6 months, 8 months while you're wrapping up your senior year of college or your first couple of years out, and then somebody decides they're going back to med school, but they walk out with 22% of the company, because their fathers knows lawyers and they're going to protect it, and they've got founder shares, and next thing you know, you're trying to get other outside investors to come in, but there's a 22% block that's solid and blocked out, and it's not going to be part of the team going forward. So these things are really important, and there's a concept you'll hear of called reverse vesting, which means that if the founder is there for 4 years, you basically treat them as if they don't have stock, and if they do leave, they have to give the stock back. So these kinds of things are essential, particularly when you have young startup teams. And forgive me, because a lot of my experience is really in this arena. So I don't know how applicable this is if there's a spin out from Goldman Sachs or what have you, but I certainly know this end of the game for the young startups. And I think it's also applicable for family businesses when you're dealing with the brothers and the sisters and the second generations. Titles and roles. This is really ego management. You know, you have 2 or 3 people, and you decide. And I'm not a fan of the LLC, particularly for this reason, because at some point you have to pick a CEO, and the CEO is going to have a little bit more than everybody else, and certainly he's going to have legal authority in the company, as well as he's going to be the jockey on the horse that ultimately everybody's betting on. So this is a key issue for these startup companies, that there's a management of this ego process. I can tell you some of the brutal meetings are these first sessions when someone gets, downgraded, that, you're going to be the marketing communication specialist. Well, that's a long way from, executive vice president of marketing, because really they don't have the skills to do that. And this becomes more and more important as the company grows. And then succession and buyouts. It's not uncommon for people to leave the business, so you might have to incorporate concepts like death insurance or key man insurance, because you have to replace an executive that leaves the company. So if you have to go out and recruit a CEO, if you've got to recruit a CTO, then you're going to need some money available to do that. I had a personal instance where one of my companies, which I was a part of, we had just taken an investment from IBM, and 90 days later the CEO went down with an aneurysm. And that went on for like 3 years. So these things are really, really critical. It's very helpful to have a good team of senior advisors on your, as part of your configuration when you're starting. So what's the message? These are going to hit you. So you got to deal with them early, and you got to get the definitions of whatever you decided to do in writing. Because short of that, nobody's going to remember what you said, and so-and-so took your girlfriend when you were a freshman year, and all this stuff's going to come up. So you want to avoid all of the noise and make sure you nail down what is going to be the executable actions. Shareholder agreement's great. I think this is really important, particularly when it comes to founders that are leaving. So you want to know what happens to their shares. And then, as I mentioned, and I think these guys have reinforced, that it's significant at this stage of the game to have a couple of trusted senior players in the story. Okay?
You guys, I would just say, I'd echo what Jack said, and sort of give one personal experience. The importance of having this addressed early on, because over the I've been doing this a whole lot of years, but I'd say over the last 2 years, I've seen numerous, 4 or 5 at least, instances of companies that have come to me. They've been inadequately formed in the beginning. Maybe there was no lawyer involved. Maybe it was on LegalZoom, whatever. And the founders had a falling out or a disagreement, or they just they underestimated each other's capacities, and they came to me and said, "What can I do?" And one of them had an LLC agreement. It was a LegalZoom LLC agreement. It had no vesting provisions. It had no buyout rights. It had no supermajority voting. It had basically nothing. And I had to say to the guy, he said, "What can I do?" And I said, basically, the only right that you have is to tank the company. That's the only thing that you can do on your own without the agreement of your partner. And I bring this up, and I bring it up advisedly, and I hate to be in a position where sound like I'm shilling for my profession, but I would be doing a disservice if I didn't say that how important these issues are that Jack has mentioned, and several times I've seen companies go south that should have succeeded and should have done well, or at least end up spending multiples in legal fees trying to negotiate a problem out that could have been resolved with a couple $1,000s for a shareholders agreement in the beginning. So I would urge everyone to take that seriously. Don't delay. You may think you have an agreement early on, orally, but as soon as there's a divergence of viewpoints and interests, then everyone forgets exactly what that agreement was, and then you've got a problem. So
I just want to reinforce that, and this is, I'll take my $10 later, but the point is that out of the companies, and if I were to poll you guys, out of the early stage companies that have matured and are ready to move on and get funding, I would, and I'm guesstimating, I've seen probably a third to 50% of them with shareholder issues, early stage, because they didn't address it early. And the amount of at that point, they're still scaling and they need money, but the resources and time that gets expended and the attention taken away from the business, because now it's between the shareholders and they're trying to resolve this issue, it's enormous, and it delays their progress. It's only, as Paul's saying, it's not big money up front. It's something that needs to be addressed, but it's always that difficult conversation that everybody's avoiding.
And I don't think it's a money issue. I think it's an ego issue. I think, anybody's ever dealt with a partner and then all of a sudden, things change and, roles change. It's all about managing those egos, and it's always important, and it's very helpful to have a third party so you get a triangle in the equation as opposed to two people standing across the room from each other yelling and throwing things. So, and I'm sure all of us have lived through something like that. So.
All right. So, industry intelligence?
Sure. I think industry intelligence is obviously critical for two reasons. There's an internal reason, because you want to know that the company that you're creating, or the product that you're creating, or the service is going to have demand. So understanding what the market is and how it values what you do is important. And also from a fundraising and ultimately an exit standpoint, in my experience, venture and growth equity investors, one of the 3 or 4 key things they look at is what industry are you serving? What's the size of the market? What is it growing? What's the complexion of it? How much money has been thrown into it? And you may be surprised, a lot of companies that kind of start up on an idea haven't really vetted the essentials in that respect. So it's critical to know who are your competitors, big or small, kind of what their marketing message is. What's your market in terms of narrowly defined, what are you the best at? And then more broadly defined, how big is the addressable market, and what are the trends there? And then kind of what kind of investment is going into the market, who are the buyers, and understanding that is very helpful. And you never really know ultimately who will be your acquirer. You may have a strong hunch. Very often it's not who you think it is, but the other benefit of knowing your industry is you can start to think about who ultimately would be your ultimate parent if and when you decide to sell. And so knowing the industry helps you understand that more quickly. And given the bane and the blessing of the internet is everything is out there. You can find your competitors. You can find out how they're marketing. You can borrow ideas from them. And the bane is that they can borrow ideas from you, and there's a lot of noise in the marketplace. But you're really doing yourself a disservice if you're not spending a significant amount of time understanding exactly the market that you're serving and how you're attacking it, and differentiating yourself and who you're fighting against. It's kind of a SWOT analysis.
Yeah, I had a different angle on this a little bit, and I think it ties to this slide and the next slide. And that I made the assumption that you're a pretty good company, because if you're going to be acquired, nobody's going to acquire a crummy company. So this is kind of like a byproduct of taking care of your customers. Because if you're taking care of your customers, you got your finger on the pulse, you know what's happening. And the other thing is, rarely is a company, certainly in tech, rarely is a company that doesn't know you, a partner, a competitor, what have you. Somebody out of the blue is highly unlikely to come and acquire you. So it's likely going to be somebody you're dealing with on a regular basis because you're sharing code with them, you've got integration agreements, you've got special partner agreements. Those companies, you're on their radar if you're good. So build a company to be really successful, take care of your customers, and a lot of this stuff is just going to be a byproduct of everything else.
Yeah, I think that's absolutely correct. The one thing I would sort of tweak, at least in the technology world, the velocity of change has been immense. You think about social and mobile and cloud, and so your ultimate acquirers could change 3 or 4 years down the road. If you can cite many examples, but you look at Dell, the recent acquisitions they did. You would be very difficult 3 years ago or even 2 years ago to predict, that they would end up buying a cloud security company, and they would end up buying Quest, which has a multiplicity of different little products, and they'd buy a threat management company. So you can control what you can't control, as Jack said, which is you can treat your customers well, but from a strategic standpoint, knowing how the market values what you're doing for the customers is very important, and knowing if the market's commoditizing or not. And you may experience it in your business, but there are things kind of further out the horizon that having the intelligence would help you address. And so relatedly, in terms of building value in the enterprise, one of the benefits of keeping abreast of intelligence is that you can sort of keep a grounding as to kind of how the company is valued. It's relatively easy to sort of keep comps, a little bit like real estate comps, of what deals have happened in your space, who's raised money, and I think it's helpful because also, even before you get acquired, a lot of partners may be interested in having discussions with you. They may start as business development discussions or partnering discussions, and in the back of your mind, being able to talk by analogy about what you're doing in a way that brings you in sort of on par with what you want to be valued against is very helpful. So if you have a social company and being able to sort of in your mind triangulate and say, yeah, I'm like a yammer and this is why, and making that almost second nature when you talk to potential partners is very, very helpful. So I think a lot of people do it naturally because they're interested in what they know, but I think doing the research has a tremendous amount of value, and you think about what you want to become, and you kind of work toward that. And as Jack said, you don't generally build a company just to exit. Although some companies have done very well doing that, but you focus on what's important on the day-to-day, but in the longer view, you keep an eye out of what's happening in your space and how what you're doing is being valued. And if there are companies that are somewhat similar to you, that kind of rhyme like you, understand why they're valued the way they are, and why you're and how you may assume some of that skin. I think that's very valuable.
I mean, to bring it home, I've had a couple of situations when a client was approaching an exit, and the guy would say to me, it turns out what they really care about, I thought they cared about how many cities I was rolled out in. And so here I've been busy rolling out cities. And it turns out all they care about is my technology. All they care about is the system, and they're going to roll it into their offerings. And here I was putting developer time into rolling out cities, and that wasn't really what made a difference. That's the sort of example we're talking about. What is it going to be? Is it going to be eyeballs? Is it going to be revenues? Is it going to be customers? What is the thing that they're buying? Is it your people? When I first did this a couple of years ago, it wasn't so important, but in the last 2 years, we have more and more of these deals where people are just buying a development team, more than anything else. So think about what it is that's going to give value to the company. And, I agree with Jack, build a successful company first and foremost, but think about what they're going to be buying and make sure that you're building what they're buying. So.
And Paul, one final comment on this is companies go in tiers. Everybody says, oh, well, they're going like this. They never go like that. They go like this. Then they ramp up, then they absorb what they just did, then they ramp again, then they go again. And each and every one of these tiers represents a point on these discussions. Because when you're down here in your first tier, that technology is everything. When you're in the second phase and you're starting to roll with customers, that becomes exceptionally important. So each and every one of these discussions about knowing who you are, where you are, at what time, it really relates to the tier you're in.
Outside advisors, Jack, do you want to?
Outside advisors, everybody knows you need some guys on your board or gals on your board, and you really want some industry expertise. I think a couple of elements of this, which I would ask you to incorporate into your thinking, is trust is important, but it's like, don't get your uncle because he's your uncle and he's going to be loyal and you could trust him. Get somebody that's going to make a difference. And I think this is really important, particularly for younger entrepreneurs, because you're going to need some real experience over the next 2 to 3 years as you're really getting through this birthing process. In addition, one of the things that I think is very important is when you're talking to advisors, make sure you get them to commit time. Because a lot of people say, sure, I'll be on your board or I'll be on your advisory committee and so on, and then you actually can't get them. They're on, they're in the Caribbean, they're in Europe, they're back to China, and you're desperate for a piece of information or guidance, or, somebody just came in and said, he's quitting. What am I going to do? I don't make enough money. I want more equity. So these are things where you really need to have not only expertise in the industry, the domain knowledge, but you really need somebody who's going to engage, because this becomes, not only the mentor role, but it's bringing a lot of senior advisory experience on the things that we've been talking about. Lastly on this point is beware the false advisor. I've seen a lot of guys and a few gals that have been hanging around startup companies. Once again, I default because that's my area. And the first thing they want is 5% equity, and then I'll join your board. Those kinds of things are really, they're just not helpful. It's going to distort everything. But you'll see them in the marketplace. We had a little company here. We started in New York in 2009, and we funded it in 2010. And we went to a New York-based forum. I won't say which one it was. Wasn't this one. And 2 days later, we had this guy hovering around the office. And he came in 2 or 3 times. And he was, wow, I can help you with this. I can help you with that. Finally, I said, what are you here for? And then he said, well, I've got connections, and I've got connections. And I said, well, like, do you have money? Are you ready to invest? And, he backed away. And it turns out he was connected to a group of people who were actually going out and getting on all these little boards because maybe one of them would hit. But the guy wasn't bringing money, he wasn't bringing expertise, and he wasn't bringing really contacts. So beware the false advisor. There's going to be plenty of them around these little companies.
Jack, a question. Would you say that you would seek out highly, more polished, more proven advisors that are out there and doing it because they believe in the company versus those that are looking to seek out a financial reward? I think that's what the kind of part of
I
it is.
I think that's part of it. I think it's a very delicate stage once again, and you need somebody you can trust, and part of that is the amount of commitment that they're going to make. That commitment could be in time, it could be in services, it could be in money, but you're going to need to see somebody kind of come across the table other than trust me.
All right. So we've had relatively few questions, and if that means we're answering everything as we go, that's fine, but feel free to jump in with any questions. So. Accounting and tax matters. Corey, I think this is all you. So.
The exciting part. All right, so, you know, I think the first line's actually, if you could read up above, is not really for me to be saying, but it is true. As was said before, you need advisors that are knowledgeable in dealing with tech companies, knowledgeable in companies that are seeking capital, knowledgeable in doing deals and structuring deals in the future, even in the early stages. You know, sometimes it's nice to have that person on board that's going to identify some of the issues early. Because what happens, and I think there's some examples up there, is, you know, and again, like Paul, I've experienced this way too many times where I've had to come in where they're ready to, they're in the midst of doing a deal, and when the company, the buyer walks in, or multiple companies are walking in, they're looking at the financials and they make no sense. They've got issues. They've represented that they have, you know, let's just say they have different segments of their businesses, and as we've been alluding to, I was saying, sometimes the purchase is not about you know, one segment of their business. It could be completely about another segment of their business, which could be just based on their IP and a small amount of technology. Well, if you can't identify with the streams, the customers, and the historical information that supports it so that they can come up with a base model for a value, you got problems. You're not going to get through the deal. It's going to slow down the deal, and if they get frustrated, they're going to walk away. You know, you've got to identify that early. Other issues, you know, without the right advisors, there's, especially in technology, there's a ton of tax incentives that are out there. And if you don't have somebody who's in the sector, you're just going to have lost opportunities. And that's money that could be in your pocket sometimes. Not always, but generally. State nexus. State issues are a big issue, especially in technology. Because for those that aren't aware, and if you're not, I'd be surprised, every state is clamoring for money right now. And you know, they're attacking whenever there's a circumstance that they can get their hands on some revenues. So you've got to, your nexus deals with whether you actually, they can identify who's doing business in the state. And each state has a different set of rules. So you need someone who's familiar with all the different states, especially in this world of technology. You can have a consultant sitting in a state or an employee, and you could be deemed doing business in that state. Now you go to do the deal and you want to sell the company, and all of a sudden it gets identified in due diligence. And all of a sudden there's a holdback and you don't know what the liability could be. I'll skip the other one. Go on. All right. Dichotomy between tax strategies and GAAP. If anybody's not aware, there's a big dichotomy there. GAAP is the accounting principles, generally accepted accounting principles, but GAAP is also, you know, taxes. A lot of companies are going on a cash basis. They run their books on a cash basis because all they care about is cash. Well, when you go to sell a company, people look to GAAP, which is accrual basis, and GAAP is really what identifies what your true picture of your company is, especially when it comes to revenue recognition, because when it comes to revenue, sometimes someone goes in and they have a subscription model. Say that subscription model is for 12 months. Well, you're doing cash, you're going to receive the cash, you're going to realize the income, and that's it. Well, you have an obligation for the next 12 months to support that subscription. And, you know, according to GAAP, you'd realize that over 12 months. So you know, 1/12. The reason for that is because there's costs associated with supporting that subscription model. And that's the simplest piece I can give to you. But also, say you're selling software with a maintenance program. There's multiple pieces to that contract you've identified. and the company acquiring it may have an obligation going forward of costs that may go forward, and under GAAP, we would be realizing that income in segments. And so a banker is going to want to know that, and they're going to want to know what that obligation may be going forward. Capitalization of software development, that gets blown every time. It's for GAAP, for tax, you can get the expense. You could also get some R&D sometimes. But when you do it for GAAP, the reason it's a nice thing to have on your books for GAAP is because now you're identifying for someone what you've spent, that you've developed software, and that you've actually spent, you have an investment there that it's identified on the balance sheet. R&D, I think I just mentioned before, which has to do with the fact that they're, for tax, sometimes you may get a tax benefit, some credits, but they're completely different. They're handled completely different tax versus generally accepted accounting principles. Potential buyer issues. These are big issues. Tracking, and we mentioned this before, tracking your stock issued, your options issued, and your warrants issued. And I'm just identifying the three. I can't tell you how many times it is not handled correctly. The dilution, the cap table, the shares that are out there, it's a mess, and they don't have a handle on it. They don't have it documented or signed off on. And some agreements they think they have. I'll give you a prime example. Had a company last week. Company issued shares to advisors, 1,000 shares to each advisor. They used the same agreement they used the first go around. Never adapted it, but then they did a stock dividend, which effectively made it a 10-for-1. So the first advisor really had 10,000 shares. They did every agreement, same exact agreement, they issued it subsequently to everybody afterwards. They do their cap table. We look at the cap table. Cap table is showing everybody, all the advisors having 10,000 shares. Legally, they don't. Because the 10-for-1 was before that, and they used the same agreement, and the agreement said 1,000 shares on it. So they blew it. Now, the company has increased in value subsequent to that. So now you're going to go issuing, now you're going to make it up to them. So now you're going to issue them 9,000 shares at a higher valuation, which causes tax consequences that who wants to, you blew that. And they're not going to be happy about this. So now you got to come up with a new creative way.
And then you got to come up with more stock that they can liquidate so they can cover the tax burden on the
Absolutely.
issuance.
So that's another example. Profit normalization. If anybody's going to sell a company, in simple terms, what that means is basically have a handle on what you're doing in your books, but know what is going through there that is really personalized. Things you're aggressively doing for tax purposes that you're putting through that's acceptable to the accountants that are saying, okay, I can look away. And then what would it take for you to be replaced? And at what cost? You're pulling out $300,000. For you to be replaced would be $125,000. When you're selling the company, it's one of the things that's done to measure what your true EBITDA is, so that you can increase that EBITDA number to get a higher valuation. So have a handle on that before you walk in the door. Segment reporting, I think I mentioned that before, which is know your segments, know your profit centers, so that if you have multiple potential buyers, you can identify and potentially get higher multiples depending upon where's your more profitable segment, because you may have a segment buried in there that's bringing down your margins. And if you can carve it out and show the higher profit margin, you may be able to get a higher valuation, but that's having a true handle on your accounting picture. International operations, another area. Structuring and not knowing how to handle when you're going to go international and having a tremendous amount of issues later on. Protecting your patents, dividing them up into a different company, identifying that. Knowing the jurisdictions to be in. You're ready to grab and jump on that one. But, a lot of companies, have employees over in, it could be Bulgaria, Czech, but they're not structured handling it the correct way. where they shelter themselves and dealing with the accounting flowing into the books. Tax structuring for future investments versus initial founders. That was what we were alluding to before with the LLCs and the C corps, and again going back to my point about the if you have international operations, how to structure it if you're going to have investors coming in, and if you're going to have investors coming in that are overseas investors, you've got to consider that. You got to know where your market is and where your money is going to come from. Planning for limitation on tax losses to buyers. That's an interesting one. There are elections sometimes that can be made where you don't take advantage of certain credits or items, and for instance, it would be an R&D, where you wouldn't expense it, you would capitalize it, because you know in the future you're going to sell the company. So when there are losses in your company and someone acquires it, they're limited. They're not going to get the full benefit of your losses. But so if they're not going to get the benefit of the losses, and you structure it, and the R&D means nothing to you because you're going to continuously lose money, why would you want the losses to keep flowing through? So you limit it and give the future buyer a benefit of those losses. Giving them the benefit of the losses may increase your valuation because now they're going to reap a tax benefit. So you can build that into the model when you sell. So you got to think about you got to have people that know these areas. So that kind of covers it.
Don, Jack?
I just, you may have covered this, and I spaced, but there's, depending on the structure of a deal, you can have a deal structure as a tax-free reorganization where the equity portion, that's more on the M&A side, but you could defer, if you structure it right, there are different ways to defer the receipt of the stock in a deal, which could be very important. And then there's issues on asset versus stock versus elections or quasi-asset, quasi-stock deals. And you were alluding, I think, to NOLs. And there's just a lot of considerations from an M&A accounting standpoint when you structure a deal. And needless to say, everyone here has said it, but it is important to bring on legal and accounting, even more than M&A advisory, but legal and accounting support early on to understand these things. And then the one other thing is, it could be just me, but I see more and more with whether it's a recap or an M&A transaction, the buyer will bring in an outside accountant to do a quality of earnings analysis. And it really, it just reflects that everybody's being super careful about financials. And more than once, I've seen those analyses kind of kill a deal. The accountants are brought in really to problem spot. And so it's very valuable to bring in an accountant who can sort of advise you early on how to organize yourself in a way to kind of be ready to handle that. In addition, we're also seeing, even though it's more on overseas deals, but sometimes when you're selling your company, especially if it's private equity backed, they'll do their own self-quality of earnings analysis, sometimes called a vendor due diligence report. But the point is, it's from a presentation standpoint, when you do an M&A transaction, the more you can professionalize the presentation of the financials and be aware of the issues, the better you'll be. So.
Thanks, Don. Another point I'd like to make is it relates specifically to the founders and to the majority shareholders. And as Corey has gone through this, what he really was defining was the elements of risk that are involved on the buyer side. And so what they're going to do is, if you're not clean, they're going to turn around and put that risk on you in the form of the actual purchase and sale agreement. And you'll hear things like escrow, and you'll hear things like buyout or earn out. And they'll just say, okay, well, if everything you've said is true, then great. That $30 million purchase price will be effective by 25% of it if you hit this year's numbers. And if you hit next year's, we'll give you another 25% of that. Otherwise, you won't get it. So this is how it all relates to you is how much you actually walk out with. So what you don't want to do is, just because of a bookkeeping or a lack of attention, you're going to put 20 to 40% of your total buyout exposed to the risk of not getting it right.
Yeah, I think I would just wrap up on that point. Bottom line is, if these issues aren't addressed timely, it can kill the deal. You can lose money along the way by not getting tax credits that are available to you. It can certainly ding the purchase price, as Jack and others have said, because every time something comes up in diligence that isn't right, you can be sure the buyers are going to use it as an opportunity to, as Jack said, either hold back money or lower the price or something else. So you don't want them to be the ones that are discovering things in diligence. You want to have taken care of it along the way, or at a minimum, to make sure that your accountants are the ones that find the problem and not the buyer's accountants. And I guess the way to address this, I would say, and I'll say it probably because more forcefully than Corey could say it, every company has an accountant. Everyone has someone. It may be small, it may be large. The important thing is having the right accountant, having someone that knows your space, that knows technology, that knows software, that can deal with R&D credits, that can deal with incentives, that can deal with the various issues that Corey has gone through. Make sure that you're talking to an accountant who knows what they're doing. And I'd say that would be the takeaway point here. I often have clients I'm representing, and I'll say to them, just based on what I'm hearing and what I'm seeing, are you sure your accountant's really up to the task? I'm speaking to them, I'm asking questions, I don't like the answers I'm getting, and take that seriously. And you can go and talk to a couple of other accountants and hear what they have to say. You don't have to buy, but at least educate yourself and make sure that you're dealing with someone that knows what they're doing. So, all right.
Question?
One thing you guys did cover, and since I've been on both sides, is how much diligence should the seller do on the buyer? And that's really important. I mean, I had a situation where somebody was offering some stock, and we ultimately did and realized the stock was going to go down. We didn't do the deal. We would end up getting a third of what we thought we were going to get.
Well, quick, if it's any sort of stock deal, if you don't do diligence on the seller, you really got to get it together, because if you're dependent upon the stock, you're dependent upon the seller, and you're betting on that seller, and you're at a high risk. If it's a cash deal, I just want my cash.
But if it's a cash deal and it's an earn-out, to some extent, you're still depending on the seller that he can.
Absolutely, good, very good point, and you're right on the money. But that's where you start negotiating, and you try and keep that earn-out as minimized as possible. So
yeah, I would say, I mean, this is sort of getting ahead of ourselves and really to the end game of negotiating a deal. But whenever you're dealing with an earn-out, you're in a completely different universe. And earn-outs, for those who understand them, that's when your compensation is tied to the performance of your company after it's sold. And it brings up a host of issues. How much control are you going to have over the company? Are you going to get the inputs you need in order to hit your targets? And in my experience, and others may agree, I often see earn-outs proposed in the beginning, and once you get into the negotiation, it gets so complicated. Very often, by the end of the deal, the earn-out's dropped away, and the purchase price has just been adjusted in some way, because they're complicated. They generally sellers often end up getting hurt in the process, no matter how hard they try to negotiate them. So I don't know if you guys have anything to add to that.
Yeah, well, certainly. Well, just on the first point on the buyer due diligence, if the buyer's public, it's very difficult to get more than what's publicly available, except if you're doing a public-to-public deal and you need a fairness opinion, you can ask certain questions. But essentially, it's all out there if the company's public. If the company's private, it's not unusual to do mutual due diligence and mutual reps and warranties, where as much as possible as the seller, you want the reps and warranties to be symmetrical. In terms of the earn-out, our experience, earn-outs are just very, very difficult because ultimately you don't have control of kind of what happens to the company once it's acquired. So it's so difficult you have to almost assume that you're not going to get the earn-out and that you're satisfied with a deal if you don't get the earn-out. Earn-out should not be a form of financing. It's almost better to have a seller note or something rather than an earn-out.
Question on valuation. One of the slides, and I believe Paul was talking about it too. You have the technology, the user base, profit centers. What right now currently, when you're deciding as a small business to spend money on and your time on, what and it's a case-by-case basis, but what are you seeing being most valued at this point, if you could pick one or two of those things?
Winning customers. You know, if you're not winning by selling your product to that customer and beating somebody else, and preferably a big guy, then you don't need to really go much further and mess around with the other stuff. Because when it's early, you got to win, and you got to win that sale. And once you start winning, and then people start following, and then all of a sudden you're starting to come up on, because the sales reports are coming back. We lost again to the shale company out of Pennsylvania. Well, that's when people start looking, well, what are they doing? Well, they got a really cool piece of technology, or they got a real new value prop that nobody else has. You'll come up on the radar then.
Don, do you have anything to add? Or?
No, you know, that I completely agree. Customers come before everything else. After customers, I think being very crisp and clear on your message, what you want to be. If you're private, it's better to be very, very specific and good at one thing. I see a very common problem, you know, where people try to boil the ocean and try to win customers by being everything to everyone. But when it comes to raising money and even selling, it's better to be number one in a very clearly defined space that you dominate, even if it's a much smaller space, because ultimately those are the companies that get the funding and the ultimate exit. So.
And I'd just like to add, you know, we use the example of gaining customers, but in the internet we use other metrics as well. And we all hear about number of users, they're free or non-free, then there's the number of eyeballs, and then there's the number of ads placed. And so there's another set of metrics that often by industry will govern, but I can assure you that if you're winning customers, and particularly if they're major accounts, then you're coming up on the radar.
All right, so moving on to corporate housekeeping, we're actually running a little bit behind, so we'll have to move a little faster. I'm not going to say too much about this. The bottom line is pretty clear. Keep your corporate records in order. Holding meetings where required, proper documentation of board action, shareholder action, proper documentation of equity issuance, as we already discussed. It's not difficult to get it right as you go. There's not a lot there. Annual meetings can be done by consent, written consent. Board meetings can be done by consent. There ain't a lot there as long as you do it properly as you go. If it ain't done right, then a bunch of things come up. It can slow down a deal. Again, this is the sort of thing you want to make sure your lawyers figure it out before the buyer's lawyers, because this is often the sort of stuff you can clean up. You don't want the buyers to start saying, oh, gee, what about this? What about that? You didn't get this right. Sloppy records raises red flags among purchasers. This is an important point. It's not just, we've talked a lot about when the buyer discovers something, then that's going to ding the purchase price and cause problems. A lot of it is about the atmospherics. When the buyer comes in and everything's clean and they open the corporate records and it's all there and the finances all, they tend to go, okay, it doesn't mean they're not going to do a deep dive, but it gives them the sense this is a company that's in order, they've done their homework, they're running a tight ship, and things are going to go much more smoothly. Once they start to find problems, then they're going to get concerned and think, okay, what's going on with this company? And then they're going to start to look deeper, and then they're going to find more problems, and it has a way of getting away from you. So there's a benefit just in terms of the process to having things look crisp and clean as they go. Another point, not necessarily an M&A point, but if your corporate records aren't important, if you haven't been maintaining proper corporate housekeeping, it does put the shareholders, directors, and officers at risk of piercing the corporate veil if there's ever a lawsuit against the company. So, can we move on? shareholders and their rights. We talked a little bit about the importance of a shareholders agreement in the context of the founders. It's equally important for all other shareholders. And we're going to call out just a couple of things that are important in the shareholders agreement. For example, it is critical that your shareholders agreement have a drag-along right. You don't want to get to the potential deal, have a buyer out there, and find that you need to have all of your shareholders, as in 100% of the shareholders, to agree to the deal. A drag-along right is simply a right that states that some majority or supermajority of the shareholders can compel the others to go along in the event of an acquisition. And it's a very simple matter. If the majority of the shareholders, or 2/3 or 75%, whatever the number is that's set forth in the shareholder agreement, think that it's a good deal and the company should be sold, you don't want a minority of holdout shareholders to say, no, we're not going to do this deal. We think we should hold out and do better. So it's a simple right. A shareholders agreement is a simple document as long as it's, if you do it in the beginning, make sure you have a proper drag-along right. Supermajority override over holdout shareholders, investors, that's kind of the same point, but it goes to other issues, and not necessarily a sale of the company, but other situations where you don't want minority shareholders to be able to hold out over an action that's otherwise in the interest of the company. Strategic investors. This is sort of a general question of who your investors are. Generally speaking, VC investors, angel investors, founders, their interests are going to be more or less aligned. As long as everyone is aiming towards a sale of the company at the end of the day, it's just a matter of getting the best price possible. Strategic investors raise different issues. For example, if your company is in the telepresence or the video conferencing space, and Cisco is a 10 or 25% shareholder, that is something that's going to make a difference to a potential buyer and to another buyer. Someone else who's out there in that space may be dissuaded from bidding on your company, seeing that Cisco has a significant stake, because they're going to be the industry will get the notion that, well, this is a company that is captive of Cisco. So when you're assembling your investors, when you're bringing in your pool, think about the significance of strategic investors in the context of an ultimate exit.
Paul, that Cisco investment would have come with a right of first refusal, which basically tells everybody that no matter how much diligence they do, in the end, Cisco can still take it. So you significantly reduce your pool of potential buyers just because they just don't want to go through the hassle.
Although that's absolutely right. Although I'd say that's probably a little bit less true now than it used to be. I think the marketplace is probably getting a little more savvy to strategic investors and to the rights that should be given to them. Certainly, Cisco will come in looking for a right of first refusal. Whether you give it to them is a different story.
Well, this goes back to my point earlier that particularly in the tech side, you've probably signed a development agreement with them. You probably signed a possible distribution in China agreement because they've got a field sales or an organization there. So typically these things are not just we'll do a 10% investment because we like you guys. It's because they're looking to angle into something else. So you're going to end up knitting a big portion of your company into them in one way or the other.
All right. Moving on, contracts and particular provisions. So an important part of the diligence process is when the buyer says, basically, open up your filing cabinets, and they want to see all your agreements, all your contracts with vendors, suppliers, customers, employees, shareholders, and the like. So for starters, all of that should be properly documented. I think Jack was commenting on, or I guess it was Corey, the equity issuances that hadn't been properly documented. For goodness sakes, don't get to an exit and have equity that's been issued and you don't have proper documents for it. That's just a huge red flag for the buyers. But beyond that, all of the agreements along the way should be properly documented. Everything should be signed. And one of the issues that comes up in diligence, whatever you do, make sure that your lawyers, your accountants look over your documents before the other side does. Because if you have a document that isn't signed, it's probably easy enough to get it signed. But if the other side finds it, it just, again, it just creates a bad impression. The types of provisions that prove problematic in acquisition. So these are the sorts of clauses that you need to be aware of, that if they slip into your contracts, they can create a problem in the event of a sale. Anti-assignment clauses and change in control provisions are a similar sort of issue. Often, a contract with an important customer or supplier or vendor may have a clause that's saying it is not assignable, or if there's a change in control of the company, the contract is no longer in force and effect. If that is an important contract, if it's at a favorable terms to your company or well priced or whatever it is, if you have clauses like that in your contract, you've created a huge issue, because that means that that vendor, that customer, that supplier, when they learn about the deal, they can say, well, that contract is going away. We're not going to honor those terms anymore, and one of any number of things may happen. You may need to renegotiate that deal at a higher price, and if that deal is at a higher price, that means that the purchase price is going to be lower. If it's a valuable contract that can't be renegotiated on favorable terms, it could tank the deal. The buyer may walk from the deal if that contract was important to them. There are any number of things that can happen. So this means as you go in the life of your company and you're signing these contracts, focus on these types of clauses and think not about how they, anti-assignment may not mean much to you in the moment. It'll mean a whole lot to you when it comes time to sell your company. Rights of first refusal, Jack just spoke about that. I think he said it as well as it can be said. You don't want provisions like that in there, and if you let them in, just recognize what a significant chilling effect it's going to have when you try to sell your company. Long-term leases and contracts with take-or-pay provisions, same thing. You've bound yourself into, and exclusivity provisions are the same way. You've bound yourself into some type of deal that the buyer may or may not be interested in, but is stuck with. And if it's not a deal that they regard as valuable, it may queer the deal, or at a minimum, it's going to affect the purchase price. Unusual limitations on liability or warranty commitments, same sort of issue. If you have offered warranty terms to your customers that are outside the industry norm, again, same thing. The buyers they may go ahead with the deal if they want the company, but it's going to affect the purchase price, because they're going to say, well, the cost of following through on these warranty commitments isn't something we bargained for, so we're going to reduce the purchase price as a result. Bottom line is provisions like this can result in delay, structural changes, a reduced purchase price, or tanking of the deal. But as I said, if these are the price of doing an important deal, if that Cisco relationship is important to you and you have to agree to the right of first refusal, maybe you'll go ahead and do it. But do it with your eyes open and recognize what it means down the line.
Hey, Paul, I'd like to add just a little bit of a specific instance, because it's so popular right now, which is the development of the software overseas. Many of you might be engaging, the Chinese, the Russians, the Indians, and what have you. But one of the things that you want to make sure is that in your code, there is a lot of free code in the internet. So when you're starting out, you might say, "Oh, jeepers, somebody get something off the internet. We'll get a free app. We're on the .NET stack, and there's a million free apps you can use." Well, those things may come back to haunt you. Number one, make sure you've got a license for that free app, or that you can replace it when you're ready. And two, if you're going to do it with a contract overseas vendor, make sure your software development agreement states that it is a for-hire business. Two, that they're using all code that's been legally given to you. So they may say, well, we use some of our own utilities for the low-level tasks. Well, if you don't have a universal license to use their utilities, in the body of your software, then that will absolutely come back and bite you the day you go to do your deal. So this gets to the heart of the IP issue, but it's particular when you're doing with overseas contracting.
All right, personnel issues. First, the non-tax issues, and we're going to move relatively quickly through the next few slides. Employee issues are key in any transaction. Sometimes they're what the buyer is buying, but if not, then at least the buyer is concerned about a smooth transition and about having the people on board after the sale. It's something you need to think about way long before you get to the term sheet. And from the very beginning, you need to think about how you're structuring your employer and your employee and consulting arrangements. At this point, we're talking mostly about retention, making sure your people are there at the time of the sale. How do you make sure that the team is in place following an acquisition? There are several tools that are available. One is vesting periods. We talked about vesting a bit in the beginning. It's simply the concept that if you give employees equity, it vests over time. 4 years is common for early stage companies. So you certainly want appropriate vesting provisions in your deals. Make sure that it is a vesting period that's appropriate to the life of the company. If you think it's going to take you 4 years to get to an exit, don't give people 3-year vesting terms on the contract, because what's going to happen, the exit comes along, the buyer buys, they're going to want the team in place, all the equity is invested. That means they're going to have to re-incentivize employees to stay along, and that's going to affect your purchase price because that's going to come out of your hide. Think about acceleration provisions. Generally, there's some type of acceleration on change in control. Double trigger is common in the industry. That means simply if there's a change in control, the equity does not accelerate unless the employees are terminated within, generally it's 1 year of the sale. So basically, if they're terminated without cause. If the buyer cuts them loose, just fires them, then their equity will accelerate. Under all other circumstances, their equity will continue to vest over time. That keeps them incentivized, keeps them there with the company, and so you know that you're not going to have to give them more money, more equity to stay around. Retention bonuses are something that the buyers may end up using. They may have to use if there isn't otherwise equity incentives to keep employees in place. Other employee issues to think about that are important: make sure that everyone is tied down with non-disclosure agreements, invention assignment agreements, non-competition, and work for hire agreements. These need to be in place, and they need to be in place early. I have had situations where there was an acquisition and the buyer went in to look at these agreements. They weren't in place. They said, stop the music. They made the seller go out and tie down all their current and former employees. And you know what? Especially with former employees, it ain't that easy to get those documents signed up. And it gives the employees it gives them a hammer over you, and they can use it to squeeze more money out of you at that point. So, anything to add? Yeah. Okay. Tax, personnel issues, and tax. Corey.
Right. We're limited on time, so I'm going to fly through this. Basically, if you're not aware, and this is a common issue amongst early stage companies, is that they start out. They're not able to pay the payroll taxes, so they hire everybody as independent contractors. And, if you run through the test that the IRS has, they're clearly employees because they're under your control, and they don't have any other source of income. It's over a 20-step test, but you're going to fall into one of them. That causes a lot of issues, and it causes a lot of issues later on when somebody comes in for diligence. The states are active. The federal and the states are actively pursuing this area for they need money, and they know it's a common issue. So I'm jumping over that. Tax issues with incentive plans. I wrote down stock incentive plans options versus stock appreciation rights. Stock appreciation rights, you rarely ever see that in a tech company early stage, but it's another form of giving people equity. And when you go to sell the company on a stock appreciation right, generally there's usually going to be a provision in there that stock appreciation rights are almost like shadow equity. And when you have a change of control and you're selling the company, that's cash that's got to be paid out at the time of the deal. And so that's got to be incorporated when you're doing your deal, and you better be aware of it, and that it's not cash that's going to go into your pocket because you've provided that to employees or contractors or whoever you gave it to. Types of plans, there's, when people are designing them, whether they're incentive stock option plans or non-qualified options, you've got to evaluate that and design and take advantage of ISOs, which are somewhat limited, but take advantage of them each year, and not to get deep into it, but that's strategizing early on. 83B elections, if you know you're going to be selling a company and there's a point in time that you're aware of it and you're getting options and you know it's going to happen in a year or two, you should be working out with yourself, your employees, but making them aware that there are elections that are available to minimize taxes later on when they go to execute their options. Because if they execute their options on the day you sell, well, there's no capital gain treatment there. And they're going to be taxed as ordinary income. But there's strategies that can happen earlier. And if you do the proper, which I wrote down, 409A valuation studies, which is a tax study, and minimizing the value of your stock early on and paying the tax consequences and providing them with whatever minimal cash that may be available when you design the awards for them, they're going to reap a very huge benefit should you sell the company and be taxed at capital gains rates at 15% versus ordinary rates when you sell the company. And those are some of the strategies that you really need to be aware of and provide those benefits to yourself, because you're probably getting options too, and to those around you.
One comment, this is a throwaway comment, but capital gains is it's one of those things that are up for review. So that'll change. So some of the tax rates are going to probably change next year.
It's still going to be lower than ordinary.
Yeah.
No matter what it is, it'll still be lower than ordinary. So.
All right, so last two slides. Intellectual property. For a lot of technology companies, IP is really the most significant thing they have, their critical asset. Particular considerations. Founders should have signed over the IP, and that should happen in the beginning. If it didn't, that's a problem. It's not difficult to do, but it should be properly documented. Proper employee documents, we just discussed that. Work for hire, invention assignment. Patents, trademarks, copyrights registered as necessary. In the software space, patents are not necessarily the way to go, but it's important to at least have considered whether a patent is appropriate, have spoken with the patent attorney. You don't want to learn about it after the fact that you had something that could be patented, it made a difference, and it's not protected. Do not neglect appropriate policing activity to protect your rights. Intellectual property is like real property. We have the concept of adverse possession. If people are infringing upon your IP and you are not putting them on notice and taking steps with cease and desist letters and appropriate legal action to stop them from doing so, when the time comes to enforce that you do try to enforce your rights, you may not be able to. And when the buyer comes in and is looking at this and realizes, oh gosh, there are all these infringers out there that the seller has not been going after, they're going to realize that the rights that they thought they were buying have been weakened or may not be available, and that could stop a deal cold. You should have policies and procedures with respect to open source software. Jack spoke about that a little bit. Very important. I've seen deals get stopped on this. The buyer comes in, they do an open source software audit. It turns out that some of the employees have just been building in routines, that they got off the internet or wherever they came from, and it can be a big problem, and you need to clean it up, and it costs money and it takes time. Trade secret protection, which is in some sense the alternative to a patent. If you don't have patent, and it has other value as well, make sure you understand what rights you have that can be protected by trade secrets. Make sure you have policies in place to do so. Make sure you don't give access to your confidential information without NDAs in place. In short, make sure you have a policy in place and you're following it. And just generally, all of your agreements should be drafted with a mind to protecting your intellectual property. Lastly, our favorite topic, securities laws. It's a big topic. We'll just hit on a few high points. There are significant issues if you fail to comply with securities laws, and they can come up in the context of an acquisition. Generally speaking, if you fail to comply with securities laws, it can result in enforcement actions by regulators, criminal and civil penalties, and rescission actions. That's when you have to give people their money back. It can derail or slow an acquisition or an IPO or impact the purchase price. Generally speaking, when you're giving equity to, when you're issuing equity, whether it's to founders or investors or employees or anyone else, if it's not registered, which generally does not happen in the case of early stage companies, there needs to be an exemption. Those exemptions are not difficult to identify and to comply with, but they generally involve at least some minimal filings, except in the case of founders, where there's an easy exemption that does not generally require filings. In all other cases, minimal filings are required. So the takeaway here is when you're issuing equity, that's a situation where you need to be talking to a securities lawyer, corporate lawyer, to make sure that you're doing it right. Again, it's not difficult to comply with securities laws in most instances for early stage issuances, but if you don't do it properly in the beginning, it's very difficult to clean up if it can be cleaned up at all. There are some situations where it can't be cleaned up. And this is a situation where it can potentially create a big issue in an acquisition. It certainly can queer a deal if you have significant securities problems. So the takeaway here generally is whenever you're giving equity, whether it's to founders, to employees, to investors, make sure you're working with a lawyer who knows what he or she is doing, and that you're taking advantage of the appropriate exemptions that are available. Anything else on that?
One comment I'd like to make, and maybe it's kind of a general comment, that before I talked about tiers of companies, and if you did everything we told you about today, it'd be about 500,000 plus. Right? So we all know that when you're starting little companies, you probably got the 50,000 from the parents and the uncle and so on, and you're watching every nickel. So think of it in tiers. And I think if you have a good advisor, a couple of sets of advisors, typically they'll work with you. These guys will work with you, and maybe that you end up with some kind of a delayed billing structure, or but there's ways of getting it done so that if you've got 50 grand, you don't have to spend 38,000 on getting your first issuance of securities. So these are the things that everything that Paul just mentioned about the security laws, he's absolutely correct. You got to do it right. But there are ways of doing it where it doesn't consume your liquid assets. And typically it's because these guys are good guys and they're going to work with you because they see potential, and they'd rather have a great paying customer with 250 employees 3 years from now than to get an extra couple of bucks up front. So I speak on behalf of these guys as being good guys, and I'm sure they'd work with you.
All right. So with that, we have motored through our PowerPoint. A lot of material. We have time for a couple of questions, if there are any questions.
I have a question about the employee issue, and notably about the contractors abroad. So what you were mentioning really applies to the contractors you hire in the country. What happens when you hire people in other places? Is it more that you're likely to be subject to the same conditions in the country where you hire them?
You're talking about overseas?
Yeah.
Well, first off, if you hire them overseas and you have a contract, you're going to have more of an issue. Actually, you got multiple issues, unfortunately. And I'll try to address them, and hopefully I don't go out of bounds because I got accountants in the room. But first off, you're paying people overseas, which deemed potentially you should be withhold. Well, no, you wouldn't be because they'd be overseas. you're going to have more of a local issue than you will have in the States. So I think that's going to be more of an issue. But again, you're not going to have the labor. You probably will have the labor issues at the locality. But I'm not qualified. You know, we have other entities, we all do, that would address that. I think you got a bigger legal issue. I'm sorry if I'm diverting, from a protection standpoint, where you need the lawyer. It's not going to be the labor issue. If you come here, totally different game. Totally different game.
First, make sure that contract with your contractors is a U.S. contract with jurisdiction in New York. Okay, so that's the first thing. Don't sign a contract in, Belarus, in Russian. Okay, so first thing, if it's here, then it's going to fall under our courts. So that's the first thing. The second thing is, in the contract for these hires, make sure you have an entity on the other side as opposed to individuals. Because then you've got, instead of 6 guys or gals that are working for you, you've got New Delhi Software Development Pty, and you're dealing with them. And that way, the entity on the other side manages the odds and ends of dealing with employees, and you're just dealing with the entity.
Wait, let me just add on to that, because he brings up the point. You're right. Because if you have people there that can be deemed that they're technically working for you and their lifestyle is working for you, well, that country can then come in and start attacking you in the U.S. because technically you deemed and brought Nexus into that country. And again, it's country by country, treaty by treaty. It's complicated.
It's very complicated because we work with at least 5 or 6 different countries, most of the time with companies abroad. So that makes it very, very easy, like you said, because these guys are organized, IP protection, everything is handled already.
And what I do is I make sure I go through those contracts to make sure that they have given you the universal license to use any subroutines, anything like that, that they would deem, oh, that's our software. Well, if their software gets into your software, you got a problem.
I heard that, yeah. But sometimes you got a client project and you go after a specific competency, and you just find a guy that knows, and that's it. And that's right now, and that's right
Get
here,
your
right now.
contract and have him sign it.
Yeah.
Another question?
Do the smaller companies that get bought out, do they ever retain voting rights? Or any type of decision power if it's a small company that gets bought out by a larger company?
When you say, well, I mean, depends on if they're taking equity in the large company?
How much are they buying? What percent?
I don't know. Let's say they're buying a larger percentage of the smaller company.
Under 50.
No, over 50.
Then you have no rights. You'll have nothing.
Okay.
If it's under 50, your chances of getting rights is if they were only buying 2 or 3%, and you've got an earn out in there. And this is a big negotiation item in the back end of the purchase and sale.
What do you mean? I don't know. I'm not. You want to know about what kind of retain rights you can get as a minority shareholder once you get acquired?
Yeah.
Is that? I mean, that's up to negotiation. I mean, you could still maintain. Jack's right. You lose control of the company, but you can maintain very significant rights. It's all subject to negotiation. Depends how many board seats you have and what decisions are made at the board level versus the shareholder level, and can they drag you along, and what can, it's subject to negotiation. It's not simply what % they're buying, I think.
You should also mention the employment contracts. When somebody sells, beside getting money from the company, they're likely to get an employment contract, because that might be a significant part of their remuneration.
That's true too. Yeah, I don't know if you heard that. The employee contract could be a very significant part of the remuneration. So the non-compete, it just depends.
And you also may not want that employment contract because then you're locked up, and that kind of goes with your payout. So it gets tied in. So it becomes part of the negotiation. It's going to be part of the play. So
Yeah, I mean, that's sort of that's getting to the end game in a sense. One more question. Or maybe we're done. All right. Well, listen, in closing, If anyone would like a copy of the presentation, make sure you leave us a business card. And I'd like to thank Jack, Don, and Corey for their great contributions. Let's have a round of applause.